On Monday, August 24, 2026, Solana faces a genuine fork in the road. Governance vote SGP-0003 is underway, and if fully approved it could lift daily SOL burns from roughly 650 tokens to between 7,500 and 9,000. That is up to $800,000 permanently destroyed every single day. The context matters. Solana currently issues around 60,000 to 65,500 new SOL daily, so burning 9,000 would remove roughly 1/7 of all new supply. The proposal bundles SIMD 0550 and SIMD 0553, and it is backed by Helios, Jupiter, Drift, and Solana Compass. The core idea is to make SOL scarcer by slowing token creation and increasing the burn rate. The buildup has been dramatic. On August 21, Solana's daily burn spiked to 87,000 SOL, the highest in almost 7 months, compared with a typical day of around 648. That was over 100 times normal, showing how rapidly network usage can turn burns into a powerful supply tool. Between the 19th and the 21st of August, developers also reduced mainnet slot time from 400 milliseconds to 350 milliseconds. In plain terms, blocks are produced more often, cutting confirmation latency and improving throughput. Solana-specific funds attracted $28.34 million in weekly inflows by August 23, an 8th consecutive week of institutional demand. On August 20, SOL rallied to $85.61, up 11.38% in 24 hours, helped by these upgrades, institutional buying and a short squeeze. This is where the real impact lands. Long-term holders benefit most from lower emissions. The author of SIMD 0550, known as Lostin, states that reducing emissions helps everyone holding SOL long-term. The proposal would double the annual disinflation rate from 15% to 30%, pulling the terminal inflation date forward from 2032 to 2029. It would cut future emissions by around 18.9 million tokens, worth roughly $1.4 billion to $1.5 billion at recent prices. For stackers, there is a trade-off. Lower emissions can mean smaller rewards, but fewer new coins hitting the market may support the price of what they already hold. Against this, market maker Wintermute has grown its short position to $22.62 million as of August 23. That is bearish in the short term, but it also feeds a potential short squeeze if the vote passes and Solana jumps. What comes next is not automatic. The proposal cleared an initial vote on August 5, but full approval requires 65.22 million SOL in support. As of early August, public pledges were only around 16.93 million, so the final hurdle is far from cleared. Prediction markets assign just a 1.4% probability of SOL hitting $160 by September 1, up from 1%. That tells you the market is interested but still cautious. If approval goes through, daily burns could rise 10-fold to 14-fold, and slower supply growth becomes a lasting tailwind. The key near-term signals are the vote outcome, whether ETF inflows keep running, and whether Wintermute covers its short. Any of those could trigger a sharp move. Solana is shifting from a heavily inflationary model towards something closer to a buyback-style system. SGP-0003 could remove 18.9 million SOL from future emissions, bring terminal inflation forward to 2029, and burn up to $800,000 of SOL every day. The 87,000 SOL spike on August 21 was a preview of what those burns can do. For holders, the takeaway is less dilution and greater scarcity. For traders, this is a high-stakes governance event that could squeeze short sellers. The wider lesson is simple: when a network destroys more supply than it creates, the underlying economics change. Watch the governance result, the institutional flow data, and the $85 level to judge whether this becomes a true supply shock.